we want to, I'm looking for a question that is suitable. Maybe it has the one that has a lot of calculations or quite enough calculations. There's a question that was set as question number 2. I think it was part A of December, November. I think it's November 2023 exam. So let me just look at it. It's a good practice question if you've looked at it before. Let me just see if I have opened that paper. November 2023. Okay, here it is. So we want to go to question 2 in section B still and pick out that question. Okay, here it is. So I'm basically looking at this question here, part A. Okay, so part A has 2 items. One is prepare the amortization tables for the lease liability and also the amortization tables for the decommissioning provision. So the decommissioning provision is where I-37 comes in. Remember yesterday I told you, where I come across a question that has I-37, I'll bring it in then. Then part 2 says, based on those amortization tables, determine what are the total lease obligation or lease liability value. So we're going to get the total lease liability value, then the right of use asset value, and the decommissioning provision or decommissioning liability value at the end of year 1. So for all, these are 3 figures, and want to look at the end of year 1 figure, end of year 1 balances. Okay, so at the start, they're telling me, let me just again make it bigger. They're telling me that this company agrees with another company, Maina Real Estate, to lease a warehouse for 6 years. So you see, the identified asset, specific asset is a warehouse. The lease period is 6 years, okay? Now the contract establishes a payment of 30,000 francs every year, but end of year, that word there, I want to pick it up, end, meaning that it's payment in arrears. So end of each year. So that's arrears. Even if the examiner has not used the word specifically arrears or advance, we see that he positions you end of year or start of the year. So this is in arrears. Now the interest rate has been given to me as 10%. So the implicit interest rate is 10%. Okay. Now they're telling me that for this warehouse to meet the needs of this lessee, it's necessary to make a series of modifications to the asset, including the partitioning of the warehouse. Otherwise, once the lease agreement ends, this company, B Wholesale Limited, must deliver back this asset to Maina Real Estate under the same conditions. So meaning that there's going to be that decommissioning. So they must decommission or dismantle and restore this asset to the original status. So we have a decommissioning or dismantling liability to recognize. The last paragraph says this company estimates that at the end of the 6th year, by the end of the lease period, it will have to disburse 9,000 francs to restore the asset. So that's the decommissioning liability. That will be the amount to pay at the end of the 6th year. And that means that we need to discount it to present value. And that will give me the present value of the decommissioning liability, which we shall recognize. Okay. Now, they've given us a discount rate of 9%, which we are going to use to determine the present value of that dismantling or decommissioning liability. Please, the 9% is to discount the decommissioning liability, while the the lease obligation, its interest rate is 10%. So don't confuse the 2 percentages. For the decommissioning provision, it's going to be 9%. For the lease obligation, it's going to be 10%. Okay. Now back to the scenario. They're saying that according to the information above and based on the provisions of Ifrs 16, okay, required, let's prepare the amortization table of the lease liability and the decommissioning liability. So that amortization table is going to help us establish the figures at the start of the year, and then we shall move, so at the inception of the lease, and then we shall start amortizing those every year for the lease obligation, and unwinding for the discount, for the provision for the decommissioning liability will unwind that discount. Okay, so let's move on. I think I'm thinking Excel would even be better for me, because that's the advantage of a CBE. You know, there those who are planning to have the CBE in future, waiting to have the CBE in future. Okay, so we're looking at question 2, part A. Question 2, part A. Okay, that's the November 23 exam. Okay, so where we are applying Ifrs 16. So Ifrs 16 leases and IAS 37 for the provision for the decommissioning liability. For the provision for the decommissioning liability. So we're applying IAS 37 for that one. Okay, so we want to start by looking at that initial measure or initial value of the lease obligation before we even bring in the decommissioning liability. So we shall say that we need the initial measure. So recall that I want to initially, remember our first principles, that I want to initially recognize the lease obligation and the right of use asset. I'm abbreviating that. Okay? At the inception of this. The question will be, at what measure? At what initial measure? That's what I want to calculate. I need a small working below. Get that initial measure. Okay, so my small working below here is there. So I'll call it working 1, the initial measure. Yeah, the initial measure, which will be the present value, the future lease payments. We have 6 years, and each year there's a rent being paid. And they gave us that rent. Let's just go back and double check. They told us that each year the lease rental up here is 30,000, and there are 6 years, and it's paid at the end of each year. So I'll come in and say that I need to compute that discounting, where I'll have a column for the year. So this is my column for the year. It would have other details there, but usually we are looking at the year. Then we are looking at the column for the cash flows, which is the rent you're going to pay, which is the rent that will be paid. Okay, so let me just increase this. Okay, and then I'm also going to have the discounting by using the discount rate. They've given me a discount rate for the lease obligations being 10%. Remember? Okay, then this should be able to give me the present value, which I'm looking for at the start of the lease. So I have 6 years. This year 1, okay, where all that we shall pay will be the rent. Rent paid. That rent paid will be 30,000. Okay. So the discount rate here, I hope you know the formula, is 1 over 1 plus R. 1 over 1 plus R. R is that 10%. Okay. To power 1, to power n. N could be the number of years, whereby this is year 1 to power 1. Okay. So here, if I can round this off, now for you, you'd have used your calculator. I hope you're aware. I'm taking advantage of of using my Excel. For you, you'd be saying 1 over 1 plus 10%, then to power n. N in this case, year 1 n will be 1. Okay, fine. So if I have that, then I'm able to get the present value of the future lease payments, which will be the 30,000 times that discount rate. So at the end of year one, if I round this off to 3 decimal places, at the end of year one, my present value for the rent of year one is 27,273. I'm going to run this for all the 6 years. So let's do year. So year 2, again, you'll be paying rent. It shall also come to year 3. Again, the lessee will pay rent. Then year 4, the lessee will pay rent. Then year 5, again rent. And finally year 6. Okay, so we know each year is paying 30,000. So let's put it there. On that, what will change will be the discount rates, because we're now going to be revising the years to say year 1, now year 2. You also have year 3. Of course, for you using calculator, I'm taking advantage of a computer. So for people who plan to ever have a CBE, this is how easy a CBE can be. As you're struggling with the calculator, the CBE person is just putting in his figures there, and things are running on their own. And that student is just doing copy and paste. You know, students who are fearing that computer-based exam. I remember seeing those years back for the SCCA, where they were running between countries because the other country has not yet started. They are paying the flight cost, the flight fees, the hotel, wherever. Then they pay that special fee to SCCA for the, what do you call them, the examination center to be changed to go and do the hard paper. You know, you pay a lot to do the hard thing, that calculator. You want that calculator to do this discounting, you know, whereas the one you've left back home is just running in a very smooth and fun way, and is getting it even more accurately. Okay, so of course those are the reasons why CPA Rwanda is trying to get to the CBE to make it easier for the students. Okay, fine. So, but students want the hard life. I think they're praying that the easy things don't come, the CBE. But by the way, you go to office and you use computers now. The exam you don't want to, and yet they're preparing you to do office work, which is in computers. So mean that our present value of the future lease rentals at the inception date, is the figure we have there, the 130,658. Okay, so that figure is the one that I'll go back to number 1, that I want to recognize initially the lease obligation and the right of use asset, and the debit entry there, which I'm putting back here, that I want to put the debit and the credit. So I'm debiting the right of use assets. Now I know how much to recognize there. I'm debiting it with 130,658. Okay, while I'm crediting the lease obligation. This obligation with that same figure, 130,658. Okay, as I do that, I should also be mindful of the decommissioning cost, which is where I'll come in to say that, therefore, my number, remember that this has combined both 1 and 2. Maybe I can put number 2 here for you, so that as if to say that, therefore, my number 2, the initial measure, the lease obligation, as computed above, is the present value of the future lease payments of 130,658. Is, I'm abbreviating present value, the future lease payments of 130,658. So if I go back to the sequence of the principles I gave you, so that student is going on to say that also the initial measure as number 3, the initial measure of the right of use asset, initial measure, okay, right of use asset is, call that, we're still looking at the inception date, is, so let me pick the table I gave you. Please, in the exam, it's not a requirement that it will be as full as this table here. It may be smaller than that table. But let me pick and paste it in my Excel so that what if we had all those with us? Okay, so it would be the present value of the future lease payments, the same figure you've just given up there in the initial measure of the lease obligation. That figure is 130,658, okay, which you have debited on the right of use asset in that transaction and credited on the lease obligation, which you said in number 2, or which you put in here. So that statement is repeated. You've already done it. But we're not given any direct transaction costs, so mean that we have a 0 there. In the exam, if you're not given, don't struggle to say I'm putting it there. It's of no use. They will not mark it. Just like here, we're not given the lease rentals that could have been paid in advance, so I have a 0 there. Okay. Again, now we've been given the present value of the dismantling cost. The present value of the dismantling cost. We need a working to. Okay, so let's go and pick it. So I'll have a working 2 here, which is the present value. The dismantling cost. Recall that you're going to incur or pay that dismantling cost at the end of year 6, which is payable after this period. That is to say, at the end of year 6. Okay, so that present value of the future lease, sorry, that present value of the dismantling cost is going to be computed based on the fact that you're going to pay 9,000. I remember that figure was 9,000. Let's double check. Yes, they told us that you're going to disburse 9,000 francs to restore the asset, and the discount rate is 9%, and that will be at the end of year 6. So the discount rate is going to be 9%. So mean that 1 over 1 plus 9%. 1 plus 9%. Okay, to power 6, because it will be at the end of the 6th year. Power 6. So mean that my discount rate, if I round this off to 3 decimal places, is going to be 0.596. So therefore, the present value today is 9,000 times 0.596. And that figure, if I round it off to the full amounts, is going to be 5366. 5366 is the figure I'm looking for here. So that the present value of the future, sorry, of the dismantling cost is 5,366, which we are debiting on the right of use asset in accordance with Ifrs 16. The credit is the provision for the liability in accordance with I-37. So we don't have a lease incentive, so I'll take that. So we have 0 for the lease incentives. So therefore, my initial measure of the right of use asset, if I go by the figures I have in here, is going to equal to 136,024. So 136,024 is the initial measure of this right of use asset. So I've done that. If I went back to my rules or my lineup, number 3 is done. Let me go to number 4. Remember, number 4 is subsequently to amortize the lease obligation. Number 4, I'll subsequently, at the end of each year, the end of each, which is at the end of each year, each, okay, 6 years. This, because the lease has a 6-year period, okay? I am going to amortize this obligation. They didn't ask you all the 6 years, they only asked for 1 year, but me, I'm going to do for all the 6 years as below. So we're going to amortize these obligations. So I'll have a column again for the year that also has details. But this time around, I'll have the opening balance of that lease obligation. So opening balance, the lease obligation. So every year start, what is that figure that will be in there? Okay. Then I'll check how are they paying rent. From the information, they are paying rent at the end of the year. If they're paying rent at the end of the year, then I first bring in finance cost, because when I compute interest, it should be before I adjust. Remember, we said that when you are computing that finance cost, the interest rate will be based on a lease obligation balance, which is either going to be after you've adjusted by taking off rent, or before you adjust by taking off rent. Because the rent is in arrears, then I'll take the lease obligation balance before adjusting out or taking out the lease rental. And that's why I would prefer to have a column for the finance cost coming up here for taking off the lease rental. So in bracket, I'll say this figure has come before the lease rental, paid, because this is paid in arrears. The rent is paid in arrears. Rent is paid. The exam, you don't have to write all this stuff. I'm just writing this here for you purposely. If this document comes to you, you don't wonder why did they put the finance cost there before putting in the lease rental. So mean that in this case, I'll bring the lease rental after. The lease rental after. Okay. And remember, it's going to be at the end of the year. Lease rental, which is going to be paid at the end of the year. Okay. So this should be able to give me the closing balance. I should be able to get the closing balance. Okay. So I'm going to amortize then. Okay. I'm amortizing my lease obligation. And I'm starting with year one. If I can put in all the 6 years. Okay, let me just say year one. By the rate, the finance cost I'm applying here, or I'm using here, is 10%. 10%. Okay. I'll say year one. The opening balance of the lease obligation year one is that initial measure you had, which is 130,658. Okay. Now I'll bring in the finance cost to say that I need a 10%. You see, before I take off the rent, since I'm paying in arrears, I'm computing the finance cost, but based on the lease obligation balance before taking out the rent paid. Okay. So times this figure here. Where did my lease rent go? Oh, I could have. Remember having it. I lost it somewhere. So the rental paid. This is paid at the year end. So it's in arrears. Okay, I don't know how I lost it there. It was there. Okay, so we see that our rent paid is 30,000. Okay, so I mean that my closing balance, remember, is to get the opening balance. You're amortizing it by saying I'm increasing it with the finance cost, and I'm reducing it with the rent paid. Okay, so let's ensure that these are all well rounded off. Okay, so that's my year one. The question wanted you to end there, but you could not end there to get the non-current liability without going to year two. For me, I will complete all the 6 years. Yeah, so year two, then year three, then year four, then year five, and finally year six. Okay. Now we are saying the opening balance at the start of year two is closing balance of year one. Okay. And again, you're moving in the same sequence, just like you had for the other case. Okay. So I want to pick that formula and take it down here to say that what's the finance cost in year two? The finance cost in year two is, I need this to be rounded off. I don't know, it's not rounding them off to full without decimal places. There you are. So I have finance cost in year two will be 11,372, which when I take off the rent of 30,000, my rent continues to be 30,000. The liability will close at end of year 2 with 95,096. That will be the non-current liability. Then if I come back to look at it in context of year 1, since I'm using payment in rent in arrears. Okay, so let me just copy this and take this to the other years so that I'm able to spread it across. Okay, so you realize that at the end of it all, you have amortized this to a closing balance of 0 at the end of year 6, the 6 years. Okay, because every year you're opening with the closing balance of the prior year, and every year you're computing the finance cost of that year, and the figure that's standard is the rent you pay, because they're paying rent of 30,000 every year. So that story will run on and on and on until you get it to 0. So in that case, this is what we've done. What we've done under number 4 is that we've computed the finance cost along the way. Okay, when we computed the finance cost, it was based on the figure before. The lease obligation balance was the figure before the rent paid, because the payment on rent is in arrears. So the double entry of that finance cost is you're debiting it in the P&L as a finance cost, and you're crediting the lease obligation. So let me just go and put it on my table here, so that everywhere I have a finance cost, then in this case, I am debiting the P&L, a line called finance cost, and I'm crediting the lease obligation. Okay, so let me just put that double entry in there so that it's clear that you're always debiting the P&L and crediting the lease obligation. How about the rent paid? Again, if you remember, the rent paid, they will always give it to you, and your duty is just to post it, to say that rent paid, I'll keep debiting. Where is it? Down here. I'll keep debiting the P&L, so the lease obligation account, and crediting cash. So let's go and put that above or at the start, to say that everyone you have rent, you are paying, so you are debiting the lease obligation and you're crediting the cash. So you alert the examiner that that's what's happening every year. So these double entries are what you're doing every year. For the finance cost, you're debiting the P&L finance cost and crediting the lease obligation. So every year for the rent, you're debiting the lease obligation and crediting that cash you're paying at 30,000. Okay. Now that closing balance, we want to present it under liabilities. So this closing balance is going to be presented. In the liabilities. The question is where in the liabilities? Non-current and current liabilities. Okay. So the question then is, how do we split the non-current from the current? So let's say that I'm having my presentation. So that I am having this presented in. Recall that because we're paying rent in arrears, then you are going to run up to the end of next year to first determine the non-current liabilities. So here, I want to start with the presentation that will be the non-current liabilities, because the amount of the obligation you're putting in the current liabilities is going to be a balancing figure, which you compute after having placed the figure in the non-current liabilities. So my amount that I represent to the current liabilities is going to be a balancing figure. So this is going to be a balancing figure. So you want to present that closing balance. In other words, you are trying to align this here, so that I want to present that closing balance partly in the non-current liabilities and partly in the current liabilities. So for the non-current liabilities, you're looking at the balance after the end of next year. So balance after, or you can say balance at the end of the next year. The end of the next year. So that will always be my non-current liability figure. I mean that if I'm looking at year 1, where the total liability is 113,274, the non-current liability should be the figure 95,096, which will be the unsettled amount by the end of next year. So if under 113,274, I've said 95,096 is the non-current liability, then the current liability is the mathematical difference between 113,724 minus the amount you've given to non-current liability. So I have 18,528. 18,528. So you're going to do this across each of the years. Okay. So let me copy it and take it down so that in each of the years, you're going to present the amount in the current and in the non-current liability. Like in year 2, because in year 3, the end balance will be 74,606. That becomes the non-current liability to present in the financial statements of year 2, while the current liability is the balance or the difference between the figure called 95,096 minus the figure you've given to the non-current liabilities. And you'll see that that's the same application in year 3, whereby the 52,096 non-current liability is the figure that will be closing as unsettled or as a balance in the next year 4. And the difference is now the current liability, 22,529. And that basically, that ends year 3. Year 4, again, you realize that the closing next year, 27,273, will become the non-current liability. And the current liability is the mathematical difference between the 52,066 and the 27,273. Then year 5, you realize that the non-current liability will be 0 because next year we shall have 0 balance, and that means that all these liabilities are current liability. And that certainly shows us that when you go to year 6, there's no non-current liability anymore because there's no future beyond 12 months from now. And even then, the current liability has been fully utilized up or crystallized. So that's how this table will go. So this table basically is the amortization table. That table has picked both principal number 4 and principal number 5. Sorry, principal number 7. So principal number 4 was to deal with the lease, the finance cost, so there, and to deal with the lease obligation. That's amortizing the lease obligation every year. But at the same time, if you remember, principal number 7 was to say that we want to see how much of that balance of the lease obligation is presented in non-current liabilities and presented in the current liabilities, especially if the payment of the, especially if the rent is paid in arrears. If the paid is paid in arrears, then we shall actually go that extra mile so that that amount paid in arrears, we will need to work out the next year end to establish the non-current liability, and that's what we've done here. So we kept having that next year end, which becomes our non-current liability at the end of next year if you still have a balance. And the difference becomes the current liability element. So at this point, I've done the amortization of the lease obligation. I've not only done 1 year, the exam I wanted you to do end of year 1. So in the exam, you don't have done those 2 lines or those 2 years because year 2, you need to have it help you establish the non-current liability. So you do not have done these 3 years. So this 4 more years, as I've done for me, I have time. I can do this, the entire table, for you to actually pick it and now move on, because your examiner can put in year 6 or year 4 or year 5. So you need to be smart and comfortable. So if I go back to the 7 principles, up to this point, I've done principle number 1. I've done principle number 2. So number 1, number 2, number 3 are done, okay? Just like number 4 is done. And if I skip number 5 and number 6, also number 7 is done. So we're left with 5 and 6. 5 is that every year we need to depreciate that asset using the straight line method. If they've given us the lease period at 6 years, don't even mind to say, Bruce, we're not seeing the useful life. Go with the 6 years. Assume it's the shorter of the 2 periods. Okay, so let's go back now so that again, subsequently, at the end of each year, subsequently, the end each the 6 years, I am going to depreciate the asset. And I want to again use a table. Okay, I want to use that table so that in this case again I have year 1, year 2, up to the 6 years. Okay, it's not a must that you need to use a table, but you can use it to say that I have a column for the year. I have the opening balance of my asset, the right of use asset. Okay, I have opening balance there. Then I have the depreciation. So I'll say less that annual depreciation. Okay, so this should be able to give me the net book value at the end of the year, or what we call the closing balance. The closing balance. Okay, so again, you're picking all your 6 years. Okay? So I pick all these 6 years and put them here as well. Okay, and we're saying that opening balance, if I pick it from up there, for the right of use asset, that opening balance is 136,024. If you remember, that's the initial measure of the right of use asset, 136,024. Okay, now we are depreciating this over 6 years. So shall I say that divide by 6, straight line method. Assume no residue value, and just take the figures given to you. So 136,024. Amortizing or depreciating it over 6 years. Each year, I'm having a 22,671, meaning at the end of year 1, 136,024 minus that figure. So I'll have a 113,353. Okay, as my running balance. Okay, then I'll do that for year 2. Year 2 opening balance will be the figure that closed year 1. I still have the same depreciation. The depreciation is straight line, so it's uniform. It's the same depreciation every year. Okay, so I'll do that. I'll say that the depreciation is again 22,671, and this time around, the running balance at the end of year 2 is that figure. So I'm going to do this for all the 3, so for all the remaining years to complete the 6 years. Okay, so you realize that with that uniform depreciation straight line method, all that keeps changing will be the closing balance, and then eventually you have a closing balance of 0 at the end of the this years or this period. Okay, so the question did not ask for all the 6 years on the right of use asset. They asked for only the end of year 1. I've smartly given you all the 6 years to ensure that if the examiner asks for any of the 6 years, you're clear and you're clean to go. Okay, so then there's that decommissioning liability, which I also want to unwind or remeasure. So we should also say that subsequently. Again, at the end of each of the 6 years, we shall need to remeasure. We shall need to remeasure the decommissioning liability. Of course, we're going to use that discount rate, which was given to us 9%. So mean that again, we have a column for the year. Yeah. We also have a column for the opening balance. Okay. Then we have a column for the finance cost. So the finance cost, because of the unwinding of the discount. Finance cost, bracket, unwinding the discount. So each year I'm going to unwind. I kind of compressed this. So I'm going to open it up. That's the unwinding of the discount terminology. Okay. Then this will actually give me always closing balance. Please, unwinding the discount here is going to create a finance cost, which I'll keep, by the way, I'll come back to the other. So here, I'll keep debiting the P&L, I then call it finance costs. Okay, while the credit keep increasing the decommissioning liability. The decommissioning liability. Okay, so yeah, that's the double entry I'll keep doing for that finance cost. Okay. Okay, fine. So then we shall have our closing balance. Again, we have our 6 years. We pick those from here. So we have 6 years. Okay, whereby Our opening balance at the start of year one is the figure you discounted to present value. I think we had it in working two. Here it is. So in working two, you had that 5366, which is the opening balance, and you're starting to unwind it or open it up. And the rate we're using is 9% to keep opening it up. So that here, open it up, you are saying finance cost of 9%. You come into set times 9%. So 9% of 5366. So it's 483. So mean that at the end of the year, if I'm debiting this in the P&L and crediting the decommissioning cost, then it's going to increase the decommissioning cost. So if I round this off to 4, okay. So mean that my decommissioning liability will increase because of the credit entry. So 5366 plus 483. So that unwind so that my decommissioning liability at the end of year 6 is exactly the amount I need, the 9,000 I need. So at the start of year 1, sorry, year 2, I'll bring the figure from last year end, 5849. Then I'll again apply the same formula to say that I need the finance cost, or sorry, yeah, the finance cost related to year 2, okay, which is still going to be 9%. So 9% of the 5846, and the closing balance, again, this formula, the closing balance is 56376. So let me just pick this and take it across the 6 years. Okay, so I want to ensure that I don't have decimal places here. Okay, so eventually my decommissioning liability has been, we've done the unwinding, so we've grown it to the extent that you have the required 9,000 francs to pay for that dismantling of that asset, or restoring it to its present or its original status. So you've done, this is called unwinding the discount. That's what we've done. It's unwinding the discount, and in the process you're creating a finance cost, okay, which you keep debiting and keeps increasing your discounted figure to the figure that you eventually want to see at the end of the 6th year, which will be 9,000. Okay, so again, the examiner was asking for in the year 1. If I go back to look at the requirements there, based on what we've done, okay, so they're asking us for the amortization tables, amortization tables, and the amortization tables they're asking here is basically the lease liability value, the right of use asset, and decommissioning provision at on the end of year 1. For us, we've done all the 6 years. So if the question was to be strictly looked at, that means that for the lease obligation, I'm looking at just this year 1 here. Year 1 there. Okay. Similarly, for the right of use asset, it will just be that year 1. And the decommissioning cost will still be just that one line. This here. So we'd only commit ourselves to year 1. Okay, so for us, we've done all the years, all the 6 years beyond the question. Okay. Okay, so somebody is asking that when we are answering this question, always you must follow. Always you must follow. Okay, you need to complete your sentence. The other one says, please tell us meaning of unwinding the discount. Okay, unwinding, in the English, don't struggle with it. The word unwinding the discount, in accounting, it means that you are computing a finance cost. So this is as good as saying that I'm going to recognize a finance cost. So it's as good as saying that I'm going to recognize a finance cost. That finance cost is what you've been recognizing each of the years. So next time you don't have to write the word unwinding the discount. You can say, I recognize the finance cost every year based on the interest rate and the value of the liability at the start of each year. So that's technically what unwinding the discount does. Okay, fine. So this kind of question, if I go back to my 7 aspects or principles, you realize that out of the 7, 6 I've done them. 1, I said initially, I'm recognizing a lease obligation and right of use asset. Then secondly, I say that that initial measure of the right of use asset, so of the lease obligation is measured based on the present value of the future lease payments. So we completed that. Then I said that for the right of use asset, it's not only the present value of the future lease payments, we can also have these changes or these adjustments to make. Now, in our case, we've seen an adjustment that's actually related to the present value of the future dismantling cost. So number 3 is done, is part of what we've done. Number 4, we went at the end of the year subsequently, we amortize the lease obligation. And you remember that amortization table that you had in there. Okay, so the amortization table, we picked it. Okay, so here it is. Amortization table was there. Then, so that was number 4. Then number 5, we also subsequently did our depreciation of the asset table, and we had a separate table for that. Okay, here it is. So we are done with that. Then number 6, so that was number 5 in the 7 things we did. Then number 6, we said that you may be allowed to revalue or to fair value this asset. In this case, they didn't talk about it. So please, everyone, they don't say revaluation method or fair value method. Continue with your historical cost method. Otherwise, number 7, we've allocated the lease obligation balance, which we have at the end of each year, in form of current liability and non-current liability. And you're done with this part. Do I have any questions? Any questions? Because at this point, if you see what we've done, this is the most commonly examined part of Ifrs 16. That recognition and measurement principles, both initial and subsequent. Okay? If I have any questions or comments, let me see in the chat. Somebody saying, how did you get 5366 for year 1? Let's go and see. 5366 for year 1. I think you're talking about the present value of the dismantling cost. So we had a working, I'm looking for that working, okay? That's the figure that gave us to this, the figure that gave us 5366, working 2 below. So in working 2 here, we're able to get that discount. Is it here? So in working 2, this is our working 2. We said that if we are paying 9,000 francs at the end of 6 years to dismantle to the original cost, and the discount rate we are using is 9%, then we shall get the discount rate as 1/1 plus 9% to power n. N is 6 years, because we shall pay the 9,000 at the end of 6 years. Okay, so we got the 5366 that way. The person was asking. Now that 5366 became the initial measure of the lease, sorry, of the decommissioning liability, which we have started. For it, we are measuring each year end by taking into account the finance cost. Up to which point? Up to the point where we finally get it back to the 9,000 at the end of the 6th year. So that's how we got to the 5366. The person was asking. Okay, so again in the chat, somebody says, help us another example where we have an advance. Okay. Now, do we have any question that has advance? Oh, I need to pick it up. It's a good one to actually try out so that we basically have everything with us. If we have advance and also now that we've done arrears. Okay, so we have, let's see, yesterday we had a question. I'm just trying to remember in my list of things that, list of the scenarios that usually would have advance. Let me see. The question we had yesterday was, I think, this here. No, but this was today's question, I think. Okay, I'll look for, there's something here. The subsidiary is expected to lease some equipment for mining. The equipment is to be used. In the proposal, the lease payments will be made at the start. Okay, yes, here is the start. So that's advance. Okay, according to the amount that will be agreed on in the lease to ensure that the investment made by NDP is recovered in the life of the equipment. KMC is not sure of the treatment. Okay, so it's not computational. So the question is about explaining. Okay, so it's not computation. I need to look for a question that's computation and has advance so that we're able to run the amortizations. Okay, so I can't see the question now. So the person who's asking for that, if you could share one then it would be good for us. Otherwise, I don't see it. But I have a question in the chat saying, how did you get 22671? If this person could help us to say maybe in these obligations or in the decommissioning provision or in the right of use asset, now we have to look for it because the person knows it. Maybe it's here. I can see this here. Annual depreciation. So every year, if my right of use asset is, that person who's asking, can you confirm that you had 136,024 as the initial measure of the right of use asset, which is based on the present value of the future lease payments, 136,38, plus the present value of the dismantling or decommissioning cost? Those two figures give us the initial measure of right of use asset as 136,024, and that's the figure we are depreciating over 6 years. So if we are depreciating that over 6 years, we basically came and said 136,024 divided by 6. So each year we have 22,671, and that's because IFRS 16 says depreciation should be straight line, so it's a uniform figure. Okay. Please always assume a scrap value of 0 until the examiner says that the residue value of that asset will have a figure. So depreciate the entire 136,024 divided by 6 years. So that's how we got it. The person was asking. And because it's straight line, so you have the same depreciation every year. Don't confuse it with the finance cost of a lease obligation, or even finance cost of the other decommissioning provision, because here the finance cost can keep changing every year. The figures are not the same, yet the depreciation is uniform. Okay. Then if you also remember that the finance cost on a decommissioning liability, the figure keeps changing. Okay. Fine. So I think that's what I had in the chat. Let's see if I have another question in the chat. Okay, fine. So now as I complete that bit of IFRS 16 in respect of recognition and measurement, I want to tell you and proudly tell you that that is the area that always or regularly or in most cases will come. It's the most regularly examined area. You need to have these 7 things I've said. Not all the 7 future. At least 6 of them can future. Otherwise, one of those that will not be regular in the exam is the alternative measurement approach of the right of use asset. Either you can alternatively carry it at revalued amount or fair valued amount. So that is the one that is not so regular, but the other 6 of the 7 are in there, as you've seen in this question. Okay, so do I have any questions as I move to Sarah Gisbach? Okay, so let me move to Sarah Gisbach. Okay, so that we attempt a question there as well. So Sarah Gisbach. So this question here, I'll say this is done in Excel. I send the documents to Icpar. I'll be sending that Excel I've used to the amortization and the unwinding and the depreciation. So now I want to look at Sarah and Gisbach. arrangements or transactions. Please, sell and leaseback arrangements or transactions purposely for your paper will actually be based on the lessee's side, not the lessor. Sell and leaseback. And the focus, the exam focus, is a case where the entity is the seller of an asset. So the entity is basically the seller of an asset. So they've sold off an asset, and this is leased back. And the asset, the same asset, is leased back, usually immediately. So we're looking at the seller's books of accounts. Okay, so we're basically looking at the seller's financial statements. So seller's financial statements. Hardly does the examiner examine it from the buyer's financial statements, looking at it from the person or the company that has sold and immediately leases back that asset. Okay, so here I would want you to pick 6 principles. I'll later build in a 7th and 8th principle, but I would want you to pick 6 principles that you take with in the exam. Everyone, the question is about a sell and leaseback. And in this case, they're looking at it from the seller's point of view, who becomes the lessee. So this seller now becomes the lessee. Here. Now, the seller becomes a lessee for the asset. So the asset was initially legally the seller's asset, but they have sold it off, they have lost legal title, but they're leasing back the same asset. They're leasing back their same asset. Okay, so in this case, if I have this, there are 6 things that I will want you to take note, but we can also have 7 and 8 later. I'll look at those 7 and 8 later. So these are the principles, the accounting principles. I picked from Ifrs 16. As before. Again, in summary, remember I'm summarizing these things for you. You could have 4 or 5 pages in a textbook. I'm summarizing this for you. One is always assess whether the sale satisfies the requirements of IFRS 15. IFRS 15. Remember, we did IFRS 15 as revenue from customers, contracts with customers. Okay, so does this sale transaction satisfy IFRS 16's requirement of performance obligations being satisfied? So assess whether the sale transaction satisfies the performance obligation, which is a requirement. Satisfies performance obligation as required by IFRS 15 to qualify this as a sale. As required by IFRS 15 to qualify this as a sale transaction. Qualify transaction as a sale in substance. So in substance, did I really sell? So that's number one. Usually this will be mentioned in the exam. So let me put that in bracket, that they will mention this. So this is always mentioned specifically in the exam, that it satisfies or it does not satisfy. In most cases, it will satisfy. Specifically mentioned in the exam, and we usually state sale transaction. We usually state that the sale transaction, yes, qualifies or satisfies the performance obligation under IFRS 15 satisfies this obligation, because until that statement is made, you cannot move to number 2, which I'm going to talk about, the performance obligation under IFRS 15. So the examiner will usually mention that statement. The moment you have that statement mentioned, you move on to number 2. Number 2 is that then those sales proceeds are going to be recognized in the cash and bank account of this company or the entity. So always move to tell the examiner that the sale proceeds recognized if cash received in the cash and bank account. Always in the exam. In rare cases, it could be a receivable. Rare cases, this may still be a receivable if the other person has not yet paid this company. But your exam will always take it in cash and bank. Implied in here is that you're debiting cash and bank. So debiting cash and bank with the amount of the proceeds received. Okay. Sorry for that. Okay, so you're debiting cash and bank with the proceeds received. So tell the examiner, I have received, the company has received cash, which is going to be debited in the cash and bank. If you're talking about a cash flow statement, it would even have gone to the investing activity aspects. I hope you know why a cash flow related to investing activity could be in respect, because you need to appreciate what an investing activity is. Those are activities that involve the acquisition or the disposal of non-current assets. This could be one of the non-current assets you have, and you've disposed it off and you've received cash. So to go under investing activities as a cash inflow. If I link it to that other area, I7, statement of cash flows. But now I'm restricting it to my IFRS 16 in a special case of a sale and leaseback. Number 3, I'll tell the examiner that that disposal of this asset will result into a derecognition of this asset from its prior or previous category. If it was previously PPE, I want to take it out of PPE based on the carrying amount of that asset on the date of the sale. We can say that the disposal or sale require a derecognition. So we have a derecognition of this asset from its previous category or class. Its previous class assets at carrying amount. At the carrying amount, that asset on the date of the sale. The examiner will give you that carrying amount. That date of sale, we need to derecognize it, take it out of the category it was. For example, if this was a PPE, example, if the asset was under PPE, as in the PPE category, we shall have to recognize it from the PPE category based on the carrying amount it had. Recognize the asset from PPE class as based on the carrying amount using its carrying amount on that date of the sale. Okay, so the double entry in that case is like you are debiting, or sorry, you are crediting it out of the asset like PPE. So you're crediting it out of the PPE asset. Crediting it out of the previous class. Yes, asset class. E.g., you're crediting it out of PPE because it's not PPE anymore. It's now going to be a right of use asset. You're going to rent it again or hire it again. So you're taking it out of PPE because PPE has your own assets. Now you're taking it somewhere else, and this will be at the carrying amount. At the carrying amount on that date of the sale. On the date of the sale. So that's the third thing a student should do in this paper. That the moment I have this sale and this back, and this sale and this back has qualified, then that disposal or sale will require a derecognition of this asset from the previous class of assets where it has been, and you use the carrying amount it had in that class or that debt of sale to derecognize it out. Okay? Then you're going to do what we call the gain or loss on disposal. So then you are going to get the gain, and here I'm going to call it normal. Okay, normal gain or loss on disposal. Loss on disposal. The exam have this computed. So how do you compute a gain or loss on disposal? You are going to get the disposal proceeds, which the examiner will have given you, less that carrying amount of that asset on the date of disposal. So let me insert a table in there so that the student is doing a mathematical calculation, and you're using you're basically using your calculator to get that figure done. Okay, so mean that here you're getting the normal gain or loss on disposal by getting the disposal proceeds. Okay, and the figure has been given to you. Then you're saying less the carrying amount of the asset on the date of disposal. Yes, the carrying amount of this asset, the date of sale. Okay, so that will give you the normal gain or loss on sale. So you get your normal gain or loss on sale. So I'm calling it normal, because I'm going to change it to something special or different. So the normal gain or loss on sale on disposal. So which is computed normally as your, assuming you gave this figure A and you gave this figure B. So you're saying A minus B as your A minus B to give me the figure you're about to call the gain or loss on disposal, which is C. So you have your figure there. Okay. Now I'm going to use that figure. You remember that I'm still in the fourth principle. I will use that figure later to assess the real gain or loss that I'm going to, so I can actually do it now here and for, to assess the real gain or loss that I'm going to take today, P and L. So I'll come in here and say that please note that the actual amount gain or loss on disposal, gain or loss on disposal is further computed or further adjusted or revised. Further revised. You're revising it from that normal gain, the normal gain or loss computed above. So I'm going to adjust it by doing the following. And I'm putting in a formula by saying that that normal gain or loss on disposal, which I've computed above. Now I'll say times the percentage of the asset that has been retained. So that has been transferred. So times the percentage or the proportion, at times you may want to call it proportion, but let me call it percentage of that asset that has been transferred. So that figure is going to be computed using a formula. So that percentage of the asset transferred, you have a workings below or a formula below. We call it working below. So to get that figure, that percentage of the asset transferred, you're going to get 100% of the, you're getting just mathematically that 100%, this working here, is to say that to get that, to get the percentage, the asset transferred, released, at times other books may call it released, is 100% minus the percentage of the asset retained. Percentage of asset retained. So that percentage of the asset retained is another working. Let me call this, so let's say this is working one below, working one below. So, and that working one is this here. So I need a working two to get me the percentage that has been retained, which I should bring back to feed in working one. And when I feed it in working one, I'll be able to get the figure I'm looking for up to this point. So up to this point, I'm looking for that percentage. But that percentage is not straightforward. They will not give it to you in the exam at times. Actually, they will not give it to you. You need to work it out separately by creating a working one, so that to get that percentage transferred, I need to get 100% minus percentage retained. And that percentage retained, again, they will not give it to you. You need to have it worked separately. So working two is the percentage of the asset retained, which is going to be computed mathematically as the present value. I'm abbreviating the word present value. The present value of the future lease payments. The future lease payments, at times you may want to call it the lease obligation at the start, divided by the fair value of the disposal proceeds. I'm abbreviating the word fair value. Divided by the fair value of the disposal proceeds. So students struggle with this number 4. So students can say, okay, number 1, I'll get that. They will tell it to me that the sale satisfied the performance, the transference of performance obligations in accordance with Ifrs 15. You say, take that one, I've picked it. Number 2, I will also get it because in the scenario, they will tell me what was the money you received on the disposal. So I'll debit it in cash and bank. Number 3, I'll also get that one, perhaps, because I'll take out that asset from PPE with a credit entry using the carrying amount it had on that debt. Now, number 4 is where I start struggling. So that I need to get a gain, this special gain here. I need to get that gain, which I'm going to use in the figures. So that gain that I'm going to use, we call it the this revised gain I'm going to use is going to be the normal gain, meaning that I need to first get that normal gain here. That normal gain times the percentage of the asset transferred. But that percentage of asset transferred, you cannot get it in the scenario until you come and create a working to say it's going to be the 100% minus the percentage retained. But even the percentage retained, you'll not get it from the scenario. You need to work it out yourself, that the percentage retained is the present value of the future lease payments divided by the fair value of the disposal proceeds. Okay, so therefore, when I get that, I'll come back to put it into the working of the percentage transferred, 100% minus that percentage retained. That gives me the percentage transferred. When I get that percentage transferred, I'll then take it down to the normal gain or loss on disposal to say that I'm restricting that normal gain or loss on disposal. So that will give me the figure I'm looking for. In others, I'm looking for C times the percentage transferred. So in others, it's like you're looking for that C, that figure C, which you've got up there, and that figure C, you're saying times the percentage transferred, and that percentage transferred, you've computed it somewhere down there. So you've computed it somewhere down there. Okay, so that's number 4. We're going to go through a scenario and you'll see how that comes. Meanwhile, then we shall say that that new asset, you remember it's not necessarily new, but by virtue of the fact that you have rented it back immediately, it's new in your financial statements because you took it out in number 3 to say that that asset that was PPE has been derecognized. So as if you've taken it out of your balance sheet, then you bring it back as a right of use asset. So we shall say that now, right of use asset will initially be recognized, is initially recognized, okay, based on that carrying amount, based on the carrying amount of that old asset, former asset. So the former asset was a PPE, okay? But times the percentage that has been retained, times the percentage of the asset retained. Remember that percentage of the asset retained, you already had it up there in working 2 above. So above, you had that percentage of the asset retained as the present value of the future lease payments divided by the fair value of the disposal proceeds. You are bringing it back here to say that now I'm using it. When I use it, I want to debit I want to debit that right of use asset in my balance sheet under assets. So the non-assets. Okay. Okay. Meanwhile, for number 4, when you computed this revised gain or loss on disposal based on this formula, because that revised gain or loss on disposal, you based it on this formula here. And you put it here so that this figure is basically your gain, your normal gain or loss on disposal. Okay, so you basically based it on this figure here, that working. So when you had that working, you are debiting or crediting it in the P&L. If it's a gain, you are debiting it in the P&L. So you're crediting it in the P&L. So we shall say credit the P&L if this is a gain. This is a gain. How about if it's a loss? If it's a loss, you're debiting. If it's a loss, you're debiting the P&L. If that figure you've computed is a loss. So you keep running a posting. So you credited either P&L or you're debiting P&L, depending on whether it's a gain or loss. Otherwise, for number 5, you are now coming to say, I have a new asset in my financial statements. Because its nature or type or arrangement has changed. It's not my legally owned asset anymore. It's now a right of use asset. I'm debiting it, but the initial measure is computed differently. It's not the other one you did in the normal way where you are leasing an asset for the first time and it was not the same asset you legally owned, where you say that it would have been the present value of the future lease payments plus the direct transaction costs plus the advance payments plus the present value of decommissioning costs, less lease incentives. That's not what you're saying here now. Please, you're not making that statement. Instead, here you're saying that the carrying amount of the asset I had, which I've just taken out of the balance sheet line called PPE, and bring it here, but now based on the percentage of the asset I've retained, and that percentage of the asset I've retained, I had a special working above there that gave me that figure. Okay, so that's number 5. Then the number 6 is to say that now the lease obligation will also be initially measured as the present value of the future lease payments, which we have done. So we shall say that number 6, yeah, lease obligation is initially measured as the present value, the future lease payments, and this will usually be given present value of the future lease payments. They will not make you compute it the way they would have done if it was the normal other lease obligation, where they would say the one we've just done, where they would have given you the rent per year and then the interest rate in the contract. Here they will give it to you. They will have calculated it for you. So the present value of the future lease payments. Okay, and I'm saying that this is always given in the exam. So this is always given. So these are the 6 key things you need. Okay, now maybe let me just put the 7 to say that now you start applying. Now apply. Okay, normal. Ifrs 16. Principles to measure, to subsequently measure. We call this remeasure, to subsequently remeasure the lease obligation, which is caused by amortization, and the right of use asset. And the right of use asset, which is by depreciation. Bracket, which is by the normal depreciation. So do this every reporting date. At the end, each reporting date. So you do that. That's what we did, or we said in the other case. Okay? Otherwise, in a special way, number 8, in a special case where the selling price, the selling or the disposal price for that asset, the asset on the date of sale was not equal to the normal market value or the normal market price of that asset. Normal market price of the asset, what I'll call abnormal prices. So that is to say, the asset was sold at an abnormal price. The asset was sold at an abnormal price. Then there are additional things that can come. It's not much that this bit comes, but it can come. I think recently it came. So where the price of the asset sold was not normal, it was not equal to the normal fair value of market fair value of the asset. Okay? For example, the sale was at a price that was above the fair price of the asset. The sale price was above normal market value of this asset. So in that case, you made this company or this seller, when he sold that asset, which is leasing back, he made an abnormal profit. Making an abnormal profit. That's what abnormal profits means, that the profit they made was higher than the normal profit. Okay? So mean that the profit made was higher than normal profit because you sold this asset at a price bigger than its normal price. It's different from if the sale price was lower than or was below the normal market price. Because if this normal market the asset, if the sale price was below the normal market price of the asset, then in this case you made an abnormal loss. You made a loss compared to what you would have made. So you made an abnormal loss. In this case, there was a loss there was a loss which was below. So there was, let me say, it's a loss that is not expected, a loss that is not expected in the market. So you went for that case, not expected in the market. So if the question comes and you realize that the selling price was bigger than the normal price, then that excess is actually going to bring about a financial liability. So we shall say that the excess proceeds or sale proceeds received above the normal market value, normal market price, above the normal market price will be recognized as a financial liability. This is recognized as a financial liability. It's as if you borrowed money from that person who sold the asset to. Because if the asset had a normal price of 10 million, and you're selling this asset at 12 million, that excess, that 2 million is that you have borrowed the money, you borrowed 2 million from the person you sold the asset to. It's different from the case of selling the asset below the normal price, because in this case we shall say that that loss or that less that price, that difference, let me call it that difference, which is the amount less than the normal market price. Market price will represent what we call a payment. This represents a payment, the lease rental. So that rent I'll pay, recall that I'm going to be the lessee and I will pay rent. If the asset I'm selling to this person who I'm leasing it back from, I'm selling it at 8 million, yet in the market, I would have sold that asset at 10 million. So I've accepted to take a loss or a deficit of 2 million. That deficit of 2 million is a case that I wanted to debit that loss or abnormal loss in the P&L. Wrong. Don't debit that abnormal loss in the P&L. debit it in the assets as a prepayment, because in reality, when it comes to paying rent in future, that person you sold that asset to at less than 2 million, that loss you made, you're going to compensate yourself by paying less rent over the years, as if you prepaid the rent on the day you sold the asset at less than the normal market price. So for the first case, when I received the normal price, the accounting treatment, the accounting entry, the accounting journal treatment would be to debit the cash at bank, the money with the actual monies I've received, the actual cash received. So that actual cash received is less than the normal, okay? So I'll have that. But while I do that, I'll say that I'm crediting this asset or the disposal account. Let's say I'm crediting the disposal account, the disposal of the asset account with the normal price, with the normal fair value or the normal market price. So I'll do this, the normal market price, the asset, as if I've sold the asset at the normal market price. But the reality is that I've not sold the asset at normal market price. So that extra, recall that ideally, you're debiting this cash at bank and you're crediting this disposal account. The missing credit or the other credit in this case is going to be the financial liability. So you have a financial liability under the liabilities with that difference. So that financial liability, we shall say, you're putting in that difference. That difference is going to be in the liabilities. I'll place this in the liabilities. So that's how my double entry would be when I'm faced with that scenario. Otherwise, for the second scenario where I have an abnormal loss, if I have an abnormal loss, then again, I'm going to debit cash at bank. So I'm going to accounting treatment here. Second is that I'm going to debit cash at bank. Okay, so I'm debiting cash and bank with the actual cash I've received. With the actual cash received. Maybe I needed to put figures. Let me go back to the first. So remember, I have received more money than the market could give me. The market would have given me 10 million. Me, I've received 12 million. So why don't I put my 12 million there? 12 million I've received. I've debited it in cash and bank. It's actual money in my bank account. But the disposal account should have the normal price. The normal price would have been 10 million. That would have been the normal price. There's this excess 2 million I've received. It's like I've borrowed somebody's money. It's a financial liability. So that's where I'll put it. How about in the second case? In the second case, I've received 8 million instead of 10 million. The normal market price of the asset would have been 10 million, but the real cash and bank is 8 million. So I'll go and credit the disposal account, disposal of the asset account, and that will be with the normal market price. With more market price. The normal market price of this asset, the normal market price of this asset would have been 10 million. So do you realize that there's a difference which I need to debit? So I'll come back and say that I need a second debit. That debit I don't take to the P&L to say I have made a loss called abnormal loss. I did not take into account that I should have sold it at 10. I sold at 8. You did it knowingly. You knew it. You agreed with the other person that let me sell you at less than the normal price. So that is as if you have prepaid. So that's a prepaid rent. Payment, lease, rental. Where am I putting this? I'm putting it in the assets, usually in the current assets. But it can be in the non-current, depending on when or how long the lease period will be. So just say it's got to be the assets. So this will be with the difference. That difference, and that difference is going to be in the assets. Okay? In this case, it's the 2 million. So that's how you're running your show. So in the exam, it's not very regular to get this principle number 8, that I have a special case when it came to selling that asset, which selling qualified under IFRS 15 that the performance obligations were actually transferred. The price of the sale was not the normal price, but was a special price that brought something abnormal. Either it was an abnormal profit or it was an abnormal loss. So I had something abnormal, either abnormal profit or abnormal loss. I want to account for that abnormal. It's either an abnormal profit that is going to be under financial liabilities, or it's going to be abnormal loss, which is going to go to the assets as a prepaid rent. And that's what the examiner is looking for. Okay, so I know I'm running out of time, or I've run out of time, but let's just try out a question before we forget this. I hope Icpar is okay for me to go beyond by maybe about 5 minutes. Okay. So the question I want to try out, I think, which could have had that bit of abnormal, and it's the most recent one actually, beyond, I think, beyond even the ones that would have been examined before, was a question that was examined in, I think, November 2022, I think. Try to remember. That was November 2022. No, it wasn't November 2022. It was 2025, actually. It was last calendar. Okay, so August 2025. So we're going to look at question number 3A, I think, in the sitting of August 2025. Okay, so question 3A. Let's try it out before we close our session today. Okay. I want to see whether I have the August. Yeah, here's August 2025. So I have a question in the chat. Let me see. Okay, I think somebody had it was before. Okay, so let's go to question 3, which is still section B, but only part A of the August 2025 exam. August 2025. Okay, here it is. It had 10 marks. If you see what we have here, 10 marks. Okay. Now it says, in accordance with Ifrs 16, discuss how KGS, so discuss how KGS should account for the sale and leaseback on the date of the sale and leaseback. Okay. And advise the amount. So here you need figures here. Advise the amount that will be reported as a depreciation charge. Okay. So you cannot run out from that. Okay. And the total finance cost, which shall be taken to the P&L for the year ended 30th June 2025. So our focus is year ended 30th June 2025. So I mean that beyond just 1st July, we shall also go to the end of the year. Okay, so that is the question. So 10 marks. Let's comfortably read it together, even while the time has gone, so that you don't miss this chance. Okay, so at the start, they're saying that Kimironko General Stores, which is KGS, is a retail company. It operates in Kimironko. They sell groceries to the public. Now, since last year, 2023, this company has struggled to raise finance, which they need to increase their product lines, because their product lines are being highly demanded by customers. So they're struggling to raise finance to be able to put in their operations to increase on the product lines, which customers keep going to the stores or to the supermarket asking for. So therefore, as part of the financing strategy, they have sold off their office building. So they don't need the office building. They need this, the supermarket rent place. So they've sold off this office building to somebody called M&N Limited. And the date of sale was 1st July 2024. So that's the date of sale. The disposal proceeds is 1,000 million francs. Okay, but they have immediately or simultaneously leased it back for a period of 10 years. So they have a sale and lease back for a period of 10 years. Okay, now on the date of the sale, the asset had a carrying amount of 600. So the carrying amount was 600, meaning that if they sold it for 1,000, the normal profit was 400. 1,000 minus 600, they made a normal profit of 400. But the fair value of that asset on that date was 900. In the market, the normal market price of this building is 900, but they've sold it off for 1,000. They have made an abnormal profit. They should be selling it at 900, but they've sold it at 1,000. So there's an excess money they've made, an excess profit. You know, in the total profit of 400, 1,000 minus 600. In the total profit of 400, there's excess profit or abnormal profit of 100, which we shall recognize as a financial liability. I hope you see that now. Okay, they're telling me that KGS will make annual lease payments of 115 million every year. Okay, and interest rate implicit in the contract is 5%. So that will help us compute finance cost. Okay, now otherwise the cumulative discount rate, they've even given you the annuity factor, so you don't need to get that done per year. So you can get the present value of the future lease payments using this. So recall that in this question, they've not given you the present value of the future lease payments. They want you to calculate it then. Rare. Most cases, they'll give it to you. Here, they want you to calculate it, and they don't want you to struggle calculating it. They want you to actually get that 7.72 times the 115 you're going to pay annually. And that should be able to give you the present value of the future lease payments. Okay, so let's see. We're going to discuss how this amount should be, how to account for the sale and leaseback on 1st July. And we're going to advise the amount that should be at the end of year one, recognized as depreciation and the total finance cost for 10 marks. Okay, I don't want to rush you. I know that you're worried of time. I hope you can be patient enough so that you pick this without rushing it, without me rushing it, if it's okay with you people. Because if I don't do it now, in the later session in the evening, I'll not get time to do it. Yet perhaps it's important. Okay, so let's move slowly so that you understand step by step. Okay, so here I am. So the question is called KGS, Mironko General Stores. So this is what I'm doing. I'll tell the examiner, because remember, I have these 8 things here. I'm going to pick all these 8 things, starting with the first one. That on the basis that the performance obligations have been transferred in accordance with Ifrs 15, then this qualifies to be a sale and a leaseback. Let me make that statement and I earn my first mark. So I'll tell the examiner as my answer, solution, that one, that on the basis that the sale transaction satisfies the transfer performance obligations under Ifrs 15. Please, in this paper, you don't have to give the title. You could even have forgotten that number, that Ifrs 15. You can say in accordance with accounting principles. Then this qualifies as a sale and leaseback. A sale and leaseback transaction under Ifrs 16. So you are starting to get your tick. The examiner says 1 mark. Student, tick. Starting. Those 8 things you've started to talk. Okay? Then you come in to say, however, so you jump to number 8, that however, in a special case, that sale price is not equal to the normal. In this case, it's above the normal. Therefore, we have an abnormal profit. So you want to add that second tick to say that, however, the sale proceeds of 1,000 million francs. 1,000 million francs being above the normal market price of 900 million francs for the assets. implies that there's an excess amount of 100 million francs that shall be recognized as a financial liability. Implies that an excess amount of, we want to calculate it, 1,000 minus 900, okay, which is 100 million francs, shall be recognized as a financial liability. That debt as a financial liability on 1st July. The examiner is happy to say you have picked principle number 8 here. This is the special case. You are saying that it's because it's above that abnormal profit, it's a financial liability. So the examiner is looking at that statement. You've picked it from there and you're putting it in your answer, 1 mark. In addition, you've even calculated this was not, the 100 he didn't give it to you. You sorted. So he says a calculation mark. Always when you calculate using information in the scenario, there will always be half a mark called calculation mark. So this student in that statement is making 1.5 marks. Of the 10 marks, 1.5 marks is in that sentence. Okay? Then you are saying that that 100 million, that excess amount received, that 100 million, will also be included in the computation of the present value of the future payments because you've not yet computed it. So you're going to say, I will need to include it. So we shall say the excess amount received of 100 million. You could even say in addition, because in addition, that excess amount of 100 million received will be included or used in the computation of the present value of the future payments. The computation, the present value of the future payments, because it's a liability. It is, though it's not a lease obligation, it's a finance liability. So in today's total liability, this total liability has 2 elements. There's a there's a lease liability and there's a financial liability. So I'm going to first compute the total liability and split it up. So the present value of the future liability. So the present value of the liability, of the total liability. Okay, and this will be allocated to the financial liability. In other words, we shall not allocate it to the lease obligation liability. Okay, you want to justify why you're going to put it there. It's because this is going to be refunded to the other person through excess amounts of disposal process, sorry, through excess rent you'll pay. As this will constitute, this will comprise of the excess rental to pay M and N. I think that company was called M and N, in bracket as the lessor. So when we start paying that lessor, the rent we shall pay is going to be bigger than the normal rent. So that's excess rent to pay because he gave you his extra 100. So you need to pay it back to him. So the examiner will base on this to say another tick. You are bringing out the substance over the legal form of this transaction or arrangement. Now you want to compute that figure. You want to compute that total that total or liability. So we shall say that the total liability, to M and N on 1st July 2024 is initially measured as, you're going to get the calculation mark. It means that you're getting the amount you're paying every year. I think they gave it to us that every year you're going to pay 115, this figure here. And you're going to pay it for 10 years. These are 10 years, but the compound rate or the annuity factor is 7.72. So mean that here you're saying 115 million time was 7.72. So you want to get that calculation mark. So in my calculator, 115 times 7.72 gives me 887.8. So 887 million, 0.8 million. Okay. Which is going to be, which comprises of both the lease obligation and I could even put it, start with the finance liability, which comprises of the finance liability of 100 million, because the finance liability today is that excess million, 100 million, and balance as the lease obligation. Balance as the lease obligation. Please, that balance, you want to get the calculation mark. So that balance, you want to put it here. Say the balance is, if in total we have 887.8 million. So 887.8 million minus the 100 million I'm giving to the financial liability. Then the balance is going to be, the balance is going to be 787.8 million as the financial, as the lease obligation. You can even say as the initial measure of the lease obligation. As the initial measure of the lease obligation. So you're going to get the mark there, but you're also having calculations. Initial measure of the lease obligation. So meaning the examiner says this statement is valid, but in the process, this student has done some calculation. Beyond the other calculation that was 878 by this here, there's a calculation here. So you calculated the 887.8. So there's half a mark for that. Half a mark for the calculation. So straighting that calculation they will give you. Beyond that, even that 887.8 minus 100, you've calculated another 787.8. So there's another half a mark called calculation, because he didn't give you that 787, the one who has calculated it. This statement here has earned you 2 marks of the 10 marks. 1 mark for the principal statement. In principle, you've said what you have a total liability to recognize, and you've said that that total liability has 2 lines. One, the financial liability under Ifrs 9. By the way, the financial liability is Ifrs 9. Then the lease obligation is under Ifrs 16. That statement is a mark. But in the process, you've calculated the 878 and the 787. The 887 and the 787. Those two give you a calculation marks. Okay, so then you move on to say that for the asset, that asset which was formerly in the PPE class, as the office building will be derecognized. We shall have it derecognized. Okay? From the PPE class based on its carrying amount on the date of sale. Did they give us that carrying amount? Let's go and see. Yes, they gave. They told us that on that date, the carrying amount, here it is. The carrying amount is 600 million. So we are going to take it out on the carrying amount. So 600 million. The student who would even have wanted to say that, let me credit then that asset from the balance sheet. So you're crediting it out of the PPE class. Add that 600 million. You're later going to see me putting that in my summary. So you're earning a tick for that. That statement is tick in the paper. Okay. Then you're also saying that at this point, you are recognizing a new asset. So we shall say that the new asset in form of a right of use asset. Form of a right of use asset. Right of use asset on that date, 1st July 2024, is initially recognized in the non-current assets, because it's going to be a 10-year, this period, okay? At what amount? At its initial measure. At its initial measure. Now you're going to run some calculations. Perhaps you could say, based on, at its initial measure, based on the carrying amount. Remember, we talked about that. The carrying amount times the percentage of the asset retained. The carrying amount times the percentage of the asset retained. Which you're going to calculate later. So the carrying amount of that old asset, the former asset, the former PE asset, times the carrying amount, times the percentage of the asset retained. Okay? So that's a tick. The calculation mark, you're going to calculate it later. Maybe you want to calculate it, so say, as computed below. So that you get those calculation marks. So let's compute it below. Perhaps I may want to use a table here to be able to compute it well. So I'm putting in a table. Okay, so in my table, remember, I'm doing those two workings. So first, I want to look at the proportion of percentage of the asset that has been retained. So I need the percentage of the asset retained, because that one is more straightforward, which is always going to be the present value of the future lease payments. The present value of the future lease payments divided by the fair value, the asset, the fair value of the disposal proceeds. Now, this is why it was tricky for students. The student is asking, where is the present value of that future lease payments? You have already done it here. You've computed it in one of the points here. In this statement here, there's the present value of the future lease payments, which is always the lease obligation. And the lease obligation, you've computed it to be 787.8. So there it is. So when I say present value of the future lease payments, I mean the lease obligations. This is always the initial measure of the lease obligations. And in our case, that lease obligation is of 787.8 million. I hope that's the figure. Let's go back. 787, is it 787? Yes, 787.8 million. So there are students who would have said, I think it's 87, sorry, what was this? The students who would have said 887.8. When clearly the definition of the, the formula for getting the percentage retained is present value of future lease payments, which is the lease obligation figure. And that's 787. So either student struggles to get that numerator. If you get it right, you may also struggle to get the denominator. What's the fair value of the disposal proceeds? The student may say, I think the money we received was 1,000. Those are the sales proceeds. No, the normal market price of the asset is the fair value. The fair value of the disposal proceeds is 900. It's 900. So I would come in here to say 900, divide by 900. And put it in percentage times 100%. So my calculator, I'll have 787.8 in the numerator, divide by 900 in the denominator. So don't say divide by 1,000. Those who said 1,000, that's sitting, we are failing that question. Then times 100%. Okay, so let's get it. 787.8 and divide by 900 times 100%. I have something like 87.5, or I can round it to 53. So 87.53%. So there you are. So if I have the percentage of the asset retained, I can use it back here. I can come back here. So that first of all, you have a calculation mark here. This is 0.5. Calculated. Nobody gave you that figure. that 87, you've calculated yourself. Then you come in here to say, calculated as, assuming you had put it here, calculated as 87.53% times the carrying amount of that office building. Before you dispose it off, what was the carrying amount of that building? For 600. 600 million. So mean that the figure you're looking at here is 600 million. You're looking at 525, maybe 525.2. So this gives us 525.2 million. So the examiner says this student, for that statement up to that level, that student has earned himself a mark. That mark is the statement that the new asset is going to be now reclassified or recategorized as right of use asset, and it will initially be recognized in the non-current assets with an initial measure of 525. So the examiner says that first there's a full mark for the principal. So you have a mark for that statement, but also the calculation of 525 was your own. So there's also half a mark for the calculation. So that statement has earned you 1.5 marks. In the process, you've started working, a working below, and that working below is starting to earn your additional marks here. If you use that working to say that therefore the percentage transferred, percentage of the asset transferred is always 100% minus the percentage retained, minus the 87.53% of the assets retained. So again, you're going to get another calculation mark. So 100% minus 87.53, I'm getting 12.47. So the percentage of the asset retained is 12.47%. That is also going to earn your calculation mark because nobody gave you that figure. You've done it yourself. You see, along the way, you're getting calculation marks. Okay, then you come to say that therefore the gain on disposal of this asset is going to be computed based on, and then you need to recognize it in the P&L. Shall I say that the gain, as another point, that the gain or loss on disposal, that asset of the office building, okay, is, you're going to compute it. You remember the formula there. You're going to get the normal profit. So I'm going to have the working below. I'm going to get that calculation. Yeah. So that's gain or loss on the building of, maybe let me use the word here, of the figure I'll get below, is going to be recognized in the P&L. In the P&L. So that statement will earn you a mark. Let's calculate that gain or loss. Okay. So I'm putting another table here to get first the normal gain, and then I'm also going to get the special or the restricted gain. Okay, so I'll say that my normal gain is the disposal proceeds. Disposal proceeds. Okay, so we're going to get the disposal proceeds. Remember, we're given the disposal proceeds of, and here I'm looking at the normal gain. So the disposal proceeds based on the normal, sorry, on the normal market price. Normal market price, which is 900, not the 1,000, less the carrying amount. Less the carrying amount on the date of disposal. Carrying amount was given us as 600. 600. Okay, so that means that the normal gain on disposal, the normal gain on disposal of the asset is the 900 minus the 600. So that's where they give you the calculation mark. You have calculated. So you are going to get the 300 million. So that 300 million you qualify for calculation mark. So they give you 0.5 calculation mark. That was not here, their calculation. You've calculated